Hi, everybody. I trust you are well. I still have my beanie on from last Wednesday, Monday. Still pretty cold out here. Well, we are in the middle of winter. Thanks, Em. Thank you for hosting the show. Guys, if you have any questions, as usual, just pop them into the chat box. Let's have a look at, just going to quickly share my screen, what we have presently in the market. So Hang Seng 50, this is where we presently are. I'll talk a little bit about what's taken place since the morning. Now, this orange candle I have and orange resistance line that I have is gap down level, gap down point, because market gap down, but I always want to mark where it actually gap down, because that might be tested at some point, okay? So this is, so if you're in the market, especially colleagues on the Asian subcontinent, these markets, you know, these are your daytime markets, right? So that gap down, very important, first candle. The bears forced the gap down into the market. But the question that I've got to ask myself, if the bears are strong, why would the bears allow the bulls to create a doji candle? Which means although the bears forced it, and we're expecting bears to control the market, this little doji candle means the bulls will come back at some point. So if you were in the market early on, first trade opportunity that you'd have taken is here. Now, that's one of the opening reversals that we look at. So easy way to think of it, gap down, the market went up once to test the gap down level. Okay, so that's if you look at the line chart, that probably assists quite a bit. There is a line chart, so I can just move that here. So you see the line chart there. That's the level, and line chart is based on closes. So that's the level that the market gapped down beneath. So it's important to put that there, because a higher percentage of the times the market will come back and test that level, which it did. So if you go back to the candles, micro double top, which is simply a double top, two candles next to each other. So the bears tried to make the market turn there, failed. Bulls broke above that micro double top, but the point was to test that. Because if you're a bull, you want to see if the bears that created the gap in the first place are strong enough to defend it. So the gap was closed, bears were strong enough. Bulls tried again for a third time, and now you know when something happens three times for us, that's a three push pattern, which is a wedge pattern. Okay, so first trade you have taken is there. Now, when we take in that trade, it doesn't mean that's the only trade that you could have taken. You could have looked at this gap down and say, okay, bears are strong. On the daily, I'm in a bear market. This is put it up very quickly. Oh, goodness. Okay, you see, all of these are the measured moves and stuff that I've got for the day so far on the 5 minutes. But you can still see quite clearly where this huge 3-day bear breakout, pull back, and bears tried to accelerate and they failed. But they've been in that double top. It's a lower high double top. Okay, so we're still in a bear market. So you know on the daily, even though with the bull candle yesterday, we are still in a bear market. So when you're on the 5 minutes, if you jump to the 5 minutes, some guys just come and say, okay, gap down, I'm just going to sell at the market and I'll put a measured move stop. So when you are taking that first trade, if you take that first trade there or beneath there, you always want to put a measured move stop. Okay. And that's tighter. Okay. If you just look at the gap from the gap down level to the low, the measured move will be there. If, as I had it earlier on, you look at the last candle of yesterday. So the market actually gapped down beneath the last candle of yesterday, then it gapped down beneath its closes. So if you want to be a little bit more conservative, you put your stop at the measured move of the gap down, which is here. So hold on, guys. I didn't have my lamp on because the sun was shining, but the clouds have just come up. Just give me half a second. Let me just... Okay, all that makes a little bit better. Still, it's winter, it's shiny, stops getting shiny, all these interesting things. Okay, so that's where you put the first trade. There is absolutely nothing wrong with taking that trade if you're prepared to put a measured move on stop. If you wait to take a second entry, then of course you don't need to put a stop up there. You need a tighter stop. You can put your stop right above here, or you can put your stop here. Any of those are quite relevant. Now, the reason I'm spending a bit more time on stops, I actually realize, you know, I talk quite a bit about price action and where to put stops, but I never actually spend time to show them. So I'd rather slow down a bit every now and then and just show you where would be the most appropriate place to put the stop. So that's where you put a stop. If the market comes back all the way and stops you out, that's perfectly fine. Okay, why would you do that? Because you've got the logic behind the gap down. Okay, if you wanted to find another measured move on here, which is not necessary, but you could also say, I really want to be cautious, George. Little trading range here, high of this trading range and the low, still in the same zone. Okay, you can put a stop there. There's nothing wrong with putting a stop there. It's a conservative stop. And then if you put a stop in the market, you leave the stop to get hit. That's easier said than done, but we've really got to train ourselves as price action traders to do that. You will get stopped out, but you got to understand the logic then, right? We put a stop in the market because we know at some point we're saying, if the market comes back to this point, then I am wrong. I'm happy to be stopped out. Okay, so put the stop in and don't fumble with it. When I say fumble with it, you know, if you ever watch rugby, you know, there's a clean catch that you make to the ball, or instead of catching the ball, the guy does all sorts of funny things with it. He fumbles it and then drops the ball. Once you've worked out your technical stop and you've placed it, you leave it in the market. Okay, even if the market comes back against you, that's perfectly fine. Get stopped out. Then you get the discipline of trusting your stop. Okay, when I speak to guys that trade with me, they say, oh, but my stop almost got hit, or it got, just leave the stop where it is. If you are not comfortable with leaving a stop where the stop is, it's a big sign to yourself that you are trading beyond your risk comfort levels. And you should trade much smaller fractions of that you presently are. So if you all got trained to take 1%, you don't have to take 1% on every trade. You can break that 1% into 4 parts and take 0.25% until you see a confirmed trend, then you can then add more to it. But when you do that, then allow your stop to get hit. There is no other way to learn. So when you take in, so there's a measured move stop. Yeah, you know, on any first move, I always put a measured move stop. On the second one, I bring the stop to a technical level, which is either above here or there. Very rarely do I put a measured move stop on the second one because it's not necessary. Market will bounce off you and accelerate your way, and you put far too much risk on it by being conservative. So the second one, your stop can be there. So If you want to come back and have a look at this, let's just mark for the purposes of today. So because you're selling, that's where your stop would be. I'm going to remove this one here because that's not necessary. Okay, so if you're taking this trade, your stop can be above here or here. So let's give this a little bit more conservative one. So that's the nearest technical level to place a stop. So that's where you place a stop. Okay. So you can take that trade. I'm not going to mark it because I don't recommend you do that. These are the setups that I would recommend for you to take from the first candle, and I'll show you that if you get the chance. Then, of course, the market does its move and we break up. So if you don't take that trade, don't take a trade anywhere within this trading range here, because now we are in a trading range. Don't follow the market, just leave it. So we are now in a trading range. So if you've taken that trade, you have to wait for the for the breakout of the trading range. Then you have to wait for the pullback to see if you get an opportunity to get in. Now, after the breakout, there is the first pullback. First, a pullback is when the market pauses because you don't know that it's going to give you these two candles. Okay, so we have broken out. We're creating lower highs and lower lows. We get a green candle, pause candle. It might go up like this. We don't know, but it doesn't. But that's the first pullback. Okay, so you let that go. You wait for the second pullback. There is a second pullback, so which creates a bit of a lower high double top here. So that trade you can take if you want to take that trade. Okay. The only problem with that trade is just to your left, you can see there's a bit of buying. So there's no need to take that trade. You can let the market go with that particular trade. Okay. If you do take it, you're taking a bit of a lower probability trade, but sometimes in the midst of the market and things are moving and moving fast, you have to make decisions. So if you take a trade and make a decision, it's perfectly fine. You know, if you wait for perfection, that may not occur. That might just go down like that. And all of a sudden, hey, where is the perfection? And if you don't take that, so if you've taken that, where do you put your stop? You don't put your stop here. Okay, this is still part of the pullback. You have to go back and look to your left. Where is the nearest technical level to put my stop? Now, nearest place, and then the most conservative place to put your stop is, you see this trading range here, would be at that lower high. So that's the nearest place to put your stop. Okay, so there you can put your stop. Another place you could place your stop is every time you see a trading range, be it a distinct trading range like this, or it's a one bar trading range like this one. That's a one bar trading range. Every time you see that, it's just like seeing a news breakout, huge one candle. Remember I said every time you see a news breakout, don't do anything, wait for it to finish, and then go and find the 50% pullback. You could also look at the trading range, and you take in the trade here, there is a trading range from that low to the high of that trading range. And 50% of that trading range is a key magnet that if the market comes back to it, the bulls have to defend. So you could also put a stop there. It's a little bit more aggressive, of course, than putting a stop there. We could do that. And so the greens is where you could put your stops for each particular trade. Just move it out there. So in this pullback, you could take a trade there if you wanted, put a stop there or put a stop there. It just depends on your risk appetite. Now, question you can ask is, well, what do you mean by risk appetite? Remember, you've defined, you've taken your 1% for argument's sake, and you've broken that into 3 or 4. And you've taken one of that 1/3% or 1/4%, and that's what you're trading with. But with that 1/4%, of course, you're now going to decide, what kind of a trader am I? Am I the one that rather take the correct but conservative, put the conservative stop on, or still within my 1/3, which I'm happy to get stopped out, am I a little bit more aggressive and take a tighter entry, which is get a lot more lots, but you can get stopped out a lot more often. Still, whether you get stopped out here, get stopped out there, it's still the 1/3 or the quarter is not anymore, because you're using your lot size calculated the correct way. So that's a call that you make. So we said above the trading range or at 50% of the trading range. Now, what's interesting, see this magenta line here, it's spot on the middle of this trading range. But this magenta line is the open of the day. Okay, so if I just move it up and down, it's open of the day, which are anchored here. So it gaps down, and that's where the market opened, went down, went up, etc. Now, it's interesting that that trading range is formed, the midpoint is exactly that. So that's that to be, if you were to try and add other reasons to put a stop there instead of there, that's something else. Because midpoint of the range is just above the open. If the bears are strong, they really want to defend that particular open. So we're still in the pullback. You've taken the trade. Now, here's the thing that say you have to trust your stop. If you've taken that, you wait. Okay, it pulls back against you, you just leave it. If it goes all the way, just let it stop you, because it might turn before that. Now, having done that, and if you've missed that and you're waiting for more confirmation, you see a lower high. So this little line here, I entered it from that high to the high of this doji candle. So we have, it's a double top, but it's a lower high double top. Okay, and you say, oh, fantastic. So the bears are so strong, they're preventing the bulls from going any higher. Let me wait to see if this candle gives me an opportunity to get in, because this is a 1 bar trading range. Okay, you want to wait for a signal that says to you, higher probability for the market going your way. That's what you're looking for. So the next opportunity would have been here. So you could have taken that trade. So we've taken all our trades beneath the bear candles there, and you are placing orders in the market. Okay, so you're not selling the close, you're not trading at the market. It's a very good discipline to place orders in the market. Especially as you are building your skills, identifying how you trade, what suits your personality, etc. Once you get more comfortable with it, when you see a setup and you know where to put your stop, and you probably have all of these little pieces of paper, that kind of stuff that I keep written down that says to me, if the entry is here and I could get it out, if my stop, the stop distance is $144, so for 150, you trade so much. For a UK 100 trade so much. If you're more experienced and you have that ready, as soon as you see a setup and you know where to put your stop, you can just sell at the market. You don't have to put orders in. But that comes with time. There's no need to rush towards that. So you could have taken that trade. And if you did that, now this is the third trade in this pullback. Let me put so the pullback, so with this breakout, pullback, market went down here and then we go inside. So the pullback from the breakout beneath that trading range is another trading range, but it's still part of the pullback. Okay, trading range, breakout, pullback, trading range. So first trade, measured move stop. I mean, said first trade, height above the high of the previous trading range of 50% point. Second trade, you can put a tighter stop because there's this lower high double top, and I didn't put it's going to clutter it, but you just have a look at it. So this high again, from that high. So now we have an almost perfect double top there. So we had a lower high double top. And then we had bull's attempt, failed, and then another double top. So now, because of the strength of that lower high double top, that perfect double top, I mean, there's another, these are all factors that you've got to continue to see. Another double top there. So, lots of double tops, which means, the bulls are trying, and there's all these factors. They try once, there's another double top. They try again, so they try again for the third time. So just in this pullback, they will try it once, twice, three times, which any three attempts in a direction or pushes is a wedge. So there's double tops, there's wedge variation, which means you could put your stop just above these double tops. So that would be a perfect place to put your stop. And you put your stop just there. See this double top here, just above here. And it also happens, it's a little bit higher than the low of the trading range because the bears should theoretically defend that. So that's for that. If you want to be conservative with your 0.25% risk, you still can just managing my voice with the sweets. You still can use that 50%. I mean, with the juice, sorry. Still can put your stop there. Perfect. 1, 2, if for any reason you haven't taken any of those trades and you say, man, I just need to be more comfortable, it's perfectly fine. Okay. These trades that I'm showing you, by the way, do not take all the trades. You just have to choose the one that fits comfortable with you. And if you take one, if you've taken that one and it pulls back before it goes down, don't say, oh my goodness, next time I must wait. You take the trade. The only thing you must do always consistently is where to put your stop. Excuse me. That's what you must always do consistently. You then have another entry here. Now, the whole logic we had to put a tighter stop is even compounded. This is even compounded. There's a lot more, I call them confluence of factors. There's a lot more things that have been stacked up here to really make this ceiling quite strong. Okay. By the time you see, so if you've not taken that, or you've just come to the market and you saw that, or you're going back at the charts to get some insights into how the market works, when you see that, I mean, that's one of those trades that you got to say, man, it is just worthwhile to wait. I mean, guys who've said through the second winnings as the market with George, with me, realize that sometimes we just sit and we say, waiting. I mean, you could have chosen not to take any of these trades. You said, I'm not comfortable. Then you saw this breakout, you say, okay, now I see this trading range has created a nice level of resistance. There's a breakout, let's see if there's an opportunity. Then wait. And when you see this trade, I mean, this is a real good trade to extract wealth from the markets. Reason is, for certain, you should put your stop just above here. Double top, outside, another trading range. That's the top of the trading range. Filled, okay, top of this little trading range here, filled breakout above that, you get an inside candle. Inside candle is a inside candle, and the candle before it is an outside, is a test of the top of a trading range. It's another trading range. So inside candle is a breakout mode at the resistance level of, that's got so many multiple factors. So you take that and your stop is there. So it's a very, it's a tight stop, still your 0.25%, but you get a lot more lots. And that's where you put it. Okay. And then you wait. And then the market accelerates, or it breaks out beneath this trading range, breakout. Breakout is not very strong. Okay, if you look here, market broke out with this candle, followed through, bit of a doji, but bears were strong, so good breakout. Here with a breakout, bull candle, bear candle, bull candle, bear candle. So not a strong breakout, and we are getting into a level of support, which is the high of yesterday. Now, okay, got time, good. So at this point, you don't take any trades. Okay, I'll come and talk about the trades here. At this point, you don't take any trades. What about profit taking and profit management? So here's what you must look at. So here's first the decision you're going to make. You need to decide what kind of trader you are. In other words, know thyself. That wise saying. The reason I'm saying that is there are things that you must do and you must let happen. You must always put a stop in the market, and you must learn to let your stop hit. Don't just run away for it, put it on break even. If you go back and look at your charts, you'll see you can stop out a lot more by just putting a stop at break even. Break even is not a technical point to put your stop. It only becomes a technical point to put your stop if it coincides with other technical levels. Okay. Now, I know some of the automated processes that you are taught, move to stop to break even. That's been tested over buckets of strategies, so work with that. But as a price action trader, that's what I'm talking. I'm talking to price action traders who look at the charts and we make decisions. We don't put our stops at break even just because there is break even. Okay, so you must put a stop, you must let your stop get hit. And then, now that you must do, okay, what then you must decide in terms of stop is, are you an aggressive trader? Can you sit with tight stops in the correct place? Or do you prefer the more conservative stop in correct places? Now, putting a measured move stop, come in here and say, I'm taking trade, I'm putting a stop here, is not a wise stop. That's just waste of money. Okay. So then you decide on that what you want to do. Excuse me. The other thing you must do is make a decision on profits. How are you going to manage your take profits? As someone who is starting the first couple of years, you always need to decide the profit quantum for the strategy you are taking, if that makes sense. Okay, to just say I'm going to take my profits at 1-to-1 or 2-to-1, if it's not related to your strategy, then it's kind of the automated trading where it's been tested, right? But if you're looking at your price action, you gotta be saying, okay, if I'm taking a trade, my minimum assumption is going to be 1-to-1, but then I must decide, do I want to take the profits at 1-to-1, or do I want to let my profits run? In other words, do I want to optimize my profits? And that's determined by the strategy. When you are taking trades early in the morning, first time when the market opens. Okay, it's gapped down and it's going up, it's coming down, it's going up. We are in a reversal mode. So we are trading a reversal mindset, which means if we take in that, we know we have to manage our trades. The trend isn't created. When the trend is created, it's a different thing. Okay, so if you are comfortable to let your trades run, then don't put a take profit in. Okay, leave it open, manage it, watch it. But when you do that, you need to see where the one-to-one is. So for example, if you've taken that particular trade and you've put your stop there, using your measured move, there is entry, there is a stop. Okay, you've taken the trade there, there is the stop. At that point, it's one-to-one. Okay, so if you just want to take one-to-one, set your one-to-one and go away, it gets hits, you bank your one-to-one and then you leave it. You don't worry about all of this. But if you want to let your profits run, in other words, if you are not stopped out, because you get stopped out, remember, our trend strategies, I always work on a minimum probability of success of 60-40, which means out of 100 trades, I will win 60 and I'll make good money. 40 of them are trades that are not going to work my way, so I must manage them and see if it reverses in front of me, then I know that that's not working out, then I can exit the trade. When there's a clear reversal, I can exit the trade. I don't just exit trade because the market is moving against me. Okay. Or on those 40%, if I've gone to work, I am going to get stopped out 40% of the times. That's perfectly fine. So I know if I take that trade, I put one-to-one, 60% of them, I want to bank money, then I leave it to bank money. Okay. But also I may say, hang on, I'm sitting around and I can watch a trade. It gets to this level. That's the level where it's one-to-one. I am going to leave my trade in the market. And when I see a technical level to tighten my stop to, I will do that. So I'm not taking any other trades. I'm now managing my trades. I think a few times Robbie heard me, especially when I'm a guest speaker at trading buddies. I say, hey guys, I'm going to manage my trades. That's because I haven't put take profits in the market. It's probably in this zone. I want to wait and see. When I get this, I then say I'm not going to add another trade to the market. But I know if I was going to take a trade here, I would put a stop here or there. The moment I see where I could take a next trade and where I could legitimately put a stop, and I'm still holding on to my trade to see if I get an acceleration down, that's when I can then take my stop from here and I can pull my stop down to this level, if that's where I'm comfortable, or a tighter level. Okay. And I say, okay, I'm still not going to take any trades. I'm happy with that one trade. I just want to see. And if it starts to reverse and comes out here and just one candle stops me out, just a break even, I'm fine with that. Okay. Then I wait, there's another entry. And if I was taking the trade, I would put a stop here or a stop there. And let's say we take a conservative approach. Put the stop here. So it's the same, maybe you'd have tightened up to there. Now you can pull your stop here. Next time around, you can put your stop here. And then you just wait. Okay. Then if you just wait, the market starts to accelerate. Like, hey, good thing I didn't take my take profit here. Now I've got a little bit more to bank. Now here's the interesting thing. When you do see that, still, you don't go... You don't go and just pull your stop down and say, hey, I could have taken my profit here. Let me put my stop down. You have to wait to say, if I was to take a trade, where would I put the stop? If you took a trade anywhere in here, the only place to put the stop is still there. So there's nothing you can do. You leave it there. You've banked some profit. You know, if you start to get nervous and say, oh, we get into the low of yesterday, this red line, you can bank your profit. You know, you've got more than one-to-one. Okay, but what you're doing is trailing your stop to technical levels. That's the discipline you have to learn. So where else would you then trail your stop? So we get to the low of yesterday. A good opportunity for the bears to break beneath the low of yesterday. They create a pause candle. They come out with a breakout candle, bit of a tail. They have a follow through candle. Fantastic. They pull back. First test of the break of yesterday. Fantastic. If you were to take a trade, if you had to take a trade, that's where you take a trade. But you don't want to take that trade. You want to wait for a second test or something. But if you were to take a trade, that's where you take a trade. And if you took a trade here, then you could then pull your stop down to, I'm just going to leave those others in case we're here. You could take your trade there. And if you did that, the nearest technical level will be there. So if you were to take another stop, another trade, that's what you would do. Okay. Then breakout, pull back, and if you had to take another trade. I'm saying if because you can see the breakouts here are very weak. So the bears are losing momentum. You don't want to take trades here. Now you're just looking for where you want to trail your stop down to. You're trying to optimize your profits. So that's where you would take a trade if you had to take a trade. So if you take a trade there, it's just red. You could take a trade there. But if you're taking that trade there, breakout, pullback, you look at your breakout, you're trying to find where do I put my stop? 50% of the breakout is about there, which is just above there. So you could kind of focused on one chart, but I'm hoping that you're getting quite a lot of insight where to put your stops. What I'm going to do later on in the day, I'll take this chart and I'll make notes on it and put stops and whatever, and then I'll just post it on the ATW page or somewhere. Or let's guys give me the video and I'll just edit on as a screenshot, as what do you call that, thumbnail cover, so you can have a look at it in your own leisure. So that's where you put us. Now, why would you do that? Because you've got to be constantly asking yourself as a price action trader, what am I seeing? What is the market showing me? In the old days, I would write these things down, double tops, double bottoms, just write the names down, double tops, double bottoms, wedges, three pushes, triangles. What am I seeing? You got to continually do that, because if you do that, you're going to start to see, this thing, it just becomes so clear. Excuse me. Should have done that away. Yeah. Little trading range there. And then you look up again, you say, hang on, market went down here. Second time, third time. You're saying first attempt, second attempt, third attempt. Market has gone down 3 times. Now that's a wedge push. It's gone down 3 times after having a weak breakout, beneath the low of yesterday, which means at some point it's going to be a pullback that's going to be testing that high. If it gets back to there and I get a double top or any other thing there, I can sell again. But, I've kind of put my stop here and I get a wedge bottom. Now, because I've seen a wedge bottom and I'm trying to optimize my profits, I'm not going to wait for a pullback, because a wedge bottom, the market is tried once, twice, 3 times to break through to a lower level, and it's failed. So I'll tighten my stops once again. to the top of the wedge or to the potential breakout point of the wedge. So if you're fast enough, you see that lower test, an attempt to break out for the third time. It's failed. You put your stop there. It's too huge. You trail your stop down to here. If you're not fast enough, which is likely because you don't know what's going to happen, you could put your stop here. And that's where you eventually get stopped out. Now, you'd also see something I want to just show you quickly before we go. So we see, again, there's another trading range here. And one attempt to break failed in reversal. And then you see this bull candle try to break out, bears failed inside. I mean, you've got to get out either here or here. In this case, with the Hang Seng 50, pretty classic with these three openings. Just before it closes again, just get out, because you might get a gap up. Now, another whole different reversal situation where I took a long trade here, very small risk, I think it's about 0.25%, whatever. But that's another subject for another day. What I want to point out quickly, have a look at trading range breakout, trading range breakout, trading range breakout, trading range. So this kind of a pattern, we just call it in terms of price action, it's a trending trading range. Okay, it's a bear trend, but it's made up of all these trending pullbacks. So if you're able to spot that, you can just see that all these were forming some kind of a pattern. Every time we go to another bottom of trading range, went sideways, 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 until we eventually turned. Okay, so guys, I hope this has been useful in terms of just getting some insights into particularly where to put your entries and where to put your stops. So this will be a pretty useful video session to get back to. I'll ask the guys in the office. Well, Sam is our guy today. Thanks, Alice. So Sam will catch up. Just get a clip of this and I'll put the really detailed notes on it as the thumbnail, and guys can enjoy it. Thank you, guys. We will see you next week. Remember, Wednesdays at the Market with George, the second Wednesday of every month will be the second Wednesday of July. It's quite punchy now. It's only 4 hours, structured around the open, which is the open of the Hang Seng, the open of the European markets, and the open of the American markets, 1.25 to 1.5 hours each. If you can sit in all of them or watch the replays, just superb stuff. We will catch up with you. Have a fantastic day. Take care, guys. Sam,